Hi guys, hope you're all well. Here is a great way for you to potentially make some money with moves in commodities. In this case, we're looking at a chart of gold using an ETF which mimics the movement of gold, symbol GLD. Now, you can see here back in March earlier this year, GLD made a nice run to the upside from around 110 to 117, and from there it's moved back down to around 113, which now you can see for the last 3 days it's had a strong move to the upside, approaching this $117 level. Now, let me draw that. That is in fact what I refer to as a pullback. It's also known as a retracement or even a correction. It's this point here. This move down in relation to the previous move up is in fact a retracement of that previous move. Now, normally when you have this sort of a pattern, it's a very high probability that the stock, or in this case, the ETF, will continue rising at least back up to previous highs, which is also known as the previous resistance level. So let me also draw in where that is. That's coming in at around 118. So that would be my first target. Now, because we've had, three strong bars up, which is actually three strong solid upward moves also on above average volume, we could in fact see a little bit of a move down perhaps over the next couple of days, or maybe a little bit of consolidation, but I would also expect that we would reach this 118 level fairly quickly. So I don't expect that we would be in this trade for very long for this educational case study. Now, we could in fact also break through this level, and in fact the next level of resistance would be this gap, which is around 120, which is also a psychological resistance level. So in my view, we've got a target of around 118 to 120. Now, of course, we could be wrong on our analysis, so we need to work out at which point on this chart are we going to say we're wrong, and we may need to close out the trade for a potential loss. Now, in my view, that would be if we were to move down below this 113 level, which is this previous pivot, also the pullback. So we need to give ourselves a buffer. We can't say we're wrong if the trade comes back down to 113, because 113 is in fact the current level of support. So if I draw a trend line from the recent low to the next higher low, then you can see that's the trend line. So just as the stock moved up and then came back down and bounced from this trend line, we could have a similar pattern with the stock before it reaches our target, comes back down and bounces on this trend line. So we need to have for ourselves a buffer to allow the stock to move in its normal pattern. So for me, I think we would be wrong if you could have two stop loss levels, I guess. If you are a little more risk adverse, then you could in fact say that, if you're going to trade, if the asset trades below this trend line, so anywhere say below 114, then you're out of the trade. If you're a little bit more conservative and you are willing to risk a little more, then you could actually say that the stop loss level is any trade if the asset trades below this 113 level, so maybe around 112 or 112.50. Okay, so it all depends on your risk tolerance level. Now, I've actually got two potential trades using options that we could put on for this case study. So I'm going to walk you through two potential trade constructions that I've done using options and talk about both of those. So the first one uses options that expire in around 80 days. So expiry would be here where there's 0 days left to the options expiry. That is around the 17th of July of 2015. And in this case, we're risking $1,000 for this position. We're buying the July 15 113 call, and we're also selling the July 120 call for a total risk of $1,000 if we are to put 3 contracts on for this position. Now, let me scroll down here and show you the metrics for this particular position. Now, I like to measure my positions on how quickly does that position yield a 100% return on investment, meaning how quickly am I going to double my money. So we can see this is also, because we're using options, time is also a factor. Now, if we look down here where we have this green section, that is in fact a time of around about 20th of June, and that is when we have roughly 27 days left to options expiry. If we are at that point in time, then GLD needs to move up by a bit over 8% for us to yield a 100% return on investment. In fact, we can see the exact point at which GLD will yield for us a 100% return on investment, and that is 126.55. Now notice here that the more time that goes by, the less that GLD has to move. That's the way that this position works. So at options expiry, GLD only has to be up by 2.9% for us to yield a 100% return on investment, and that is in fact in line with our target. So that's actually at 119.70. Remembering that we have a target of between 118 to 120. Now, the only thing that I'll say is that we need to look at what is our potential loss at our stop loss level. So remember I said that the technical chart is saying that our stop loss level needs to be somewhere around 112 or 112.50 if we are a little bit more conservative, willing to risk more. Or if we're a little bit more risk adverse, then, and if our stop loss is just below this 114 level, which is below this trend line, we need to work out for those two stop loss levels, what is our potential loss. Now you can use the graph here. So let's look at the first scenario. Let's assume that we're going to give ourselves enough time for this stock to move. So we're going to use the blue line, which means we're going to give ourselves up to the 24th of May for this stock to do its thing, which means we will have at that point in time 54 days left to options 54 days left to options expiry. Okay, so roughly 26 days, roughly a month has gone by. And if a month has gone by and GLD is trading at around that $112 level, we can see we're going to be losing a bit over $500, so a bit over 50% of our initial entry cost. Okay, now that's for those who are conservative and are willing to give GLD that amount of room to move down. However, for those who may be a little more risk adverse and are only letting GLD move to that trend line, which is around, which we identify was around 114, then you would be risking around $350 for your potential stop loss. So you're risking, in this case, $350 to make back $1,000. Okay, so that's not a bad return. Now let me talk about another type of options position for this particular case study, and in this case we are buying and selling multiple options. And if I scroll down to where we have the KPIs, this particular position only needs to move. So GLD for this particular position only needs to move up by 3.5 to 4% to yield a 100% return on investment. Now, we are using shorter term options for this particular position. In this case, we only have 52 days to options expiry. So our options would expire somewhere around the 19th of June 2015. So we are using short term options. And we can see this position doubles a lot quicker. So I like this one better. We can see that even if we have a move a lot sooner, remember in the previous position, these asset ETF GLD needed to move over 12% if we only had, if we had a move in a shorter time frame. I'll switch over to that previous position and show you that if we had a move sooner rather than later, then in this particular position, which is the spread using the 113 and 120 calls, then the asset, in this case GLD, needs to move up more for us to yield a 120 a 100% return on investment. And in this particular case, it's fairly consistent. No matter when it moves, we only need to move roughly 3.5 to 4%. If it moves too soon, which is this red area here, meaning if we're moving 1 to 2 days, then we in fact need a move of around 5% for us to make a 100% return on our investment, which is in fact doubling our money. So I like this position a little better because from our technical analysis, we already identified number one thing, which is the target is not far away, so we're not expecting for a lot of time to go by before we reach that target, and it's between 118 to 120. Remember, the options position doubles at around this 120 level. So, maybe a couple of weeks need to pass by. And the other thing we need to look at for this position, how does it compare? What's the potential loss if we are going to get, how much money do we lose? How much money do we lose if the stock actually trades down lower to our stop loss level? So again, we'll use the blue line because that's a point in time where we are in middle of May and there's only 35 days to options expiry. So we started with 52 days. So, just roughly 20 days or so has passed. Now, if we move our mouse down to where the stock price is, for example, at just below 114, we're actually in fact losing more than $536. Now, that's for those who are a little risk adverse. If we are of a little more conservative and we're allowing more room for the stock to move, then the next level of the stop loss level was around that $112 mark, which means we're actually now having to risk a potential loss of over $700. So they're the kinds of things that we need to think about, folks, when we are analyzing our options positions. Now, one other thing that I like to do, because I'm not comfortable, well, I like this particular position for this case study. I like it because the stock only needs to move, or in this case, our ETF only needs to move 3.5 to 4% for us to generate a 100% return on investment. What I'm not happy about is the fact that I have to risk over $700 because that's where our chart is saying is the technical stop loss level. So what I like to do in that scenario is I like to jump into a intraday chart, looking at a 30-minute chart to identify a level on a 30-minute chart where I will be comfortable in identifying a stop loss level which would be higher than the stop loss level identified on a daily chart. So in this case, we could use the 50-day moving average as an example, and we could actually set a stop loss level at around 115. So now let's look at what that means for a potential loss. So if I move my cursor around to where we're going to be just below 115, then in this case, for this particular options trade, we're going to be risking around about $450 for this position, and we're risking that amount to generate a profit of $1,000. So that's a little bit better for me, for my risk tolerance level. Everyone has their own risk tolerance level. I like to be close to 50% of my entry cost. Now, if we look at the same stop loss level on this particular spread, again using that blue line, then if we add a risk up to when the stock is trading at around just below 115, then the loss is actually lower. So in this case, it's actually only $236.31. That's how much we would potentially lose if we were to wait for GLD to trade below 115 towards the end of May. Now, the only issue that I have with this particular position, that if the stock, the stock needs to move up over 12%, if it's to move quickly up towards that 130 level. Now, for me, I think that may be a stretch. However, if you're able to hang on to that position and the stock remains above, 125, and more time goes by, then we're able to yield a 100% return on investment a lot sooner. Where in this particular position, in this options spread, the asset only needs to move up between 3.5% to 4% for us to generate a 100% return on investment. However, the disadvantage is that we need to potentially risk a little bit more, up between $400, between 400, let's see where it is exactly. So between $500 if you are okay to have a stop loss just under 114, or a risk of over $700 if you are to have a stop loss at around 112. Okay, folks. So that's the kind of thinking process that I go by, folks. Hope it helps. Just remember, you always need to manage your risk and understand your risk, and also note that these videos are for your education only.